All right, my name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about surviving the workman's comp audit. For those of you in business that and have employees, you might have been subject to the surprise workman's comp bill. Usually the scenario is you're minding your business, or you're paying all your bills, and your insurance company comes to you and says, "Hey, look, we're doing an audit." They're asked to see certain information. You send it to them, and you're thinking it's all good because you're like, "I paid my bills. I'm up to date. I'm paying all my premiums on time." And then you submit the paperwork, and then a couple weeks later, you get a huge bill in the mail saying that you owe additional premiums. And most of the time, it catches people off guard. And you're sitting there wondering, why do I owe this and how did this happen? So I wanted to walk through at least why that happens and things that you can do to avoid that going forward with your workman's comp. So just a brief overview as far as the way that workman's comp insurance works, those policies are in place to cover your employees in the event that they get hurt while working on the job. So that's the key, while working. If they're off on their own time doing something and happen to get hurt, workers' comp does not cover that. It only accounts for if you get hurt while working on the job. So it'll cover medical expenses to help you get right from the injury. And in some instances, it will actually pay you a portion of your wages in the event that you're out of work as a result of said injury. In some states, it's mandatory to have, not in all states, mostly like in the north, northeast, or I like probably with a lot of the blue states that's mandatory. Maybe not as much as the red. Don't hold me to that, but just from my brief observation, that's what I've seen as far as who requires it, doesn't. And essentially the way that the premiums work, it is a percentage of your actual wages to your employees. Usually when you first sign up for a policy, they ask you, what are your projected wages? You let them know what the projected wages are. And based upon what you tell them, that's how they calculate the premium. So what happens when you get an audit, the audit is to make sure that the wages that you actually paid over the course of the time that you had the policy matches up to what you initially reported. And where a lot of business owners get jammed up is that the wages that they actually do pay go well over the amount they initially reported. So being that the premium is based upon percentage of wages, if you pay more than what you told them you were going to pay, then you're short. And now the insurance company comes to you and says, "Hey, look, you're short. You need to make up the difference." So that's the reasoning why you may get such a bill in the mail. I want to go through a few things that you could do to avoid being surprised by large bills. The first step is that when you first get the policy, you want to make sure that you're pretty accurate with your payroll. Some business owners want to get the lowest premium possible, so they tend to not be accurate with their payroll numbers, whether they're doing it by design or through an insurance broker, or maybe you just have a goal to just get the coverage for as cheap as you can possibly get it. When you do that, you have to report relatively low wages. Many a times you sign up these policies and you know that you're underreporting your anticipated wages. If you do that, you're just setting yourself up for a large bill later on. You want to make sure that you're accurate with what the projected payrolls will be. It may be a little more upfront, but you'll want to pay that bill over the course of the year. It's probably better to do it that way versus getting a large bill at the end of the year, because then get that large bill at the end of the year. Now the insurance company has more of an accurate idea of what your premiums are. You're going to owe them the back premiums plus the adjusted rate, which is now higher than what you've been paying. You can get yourself pretty jammed up that way. So make sure you're accurate with your payroll when you're first signing up. The next thing you'll want to do is avoid accidents. Workman's comp insurance works like any other insurance. If you have claims, you're deemed a risky investment, your premium goes up. So keep your workplace as safe as possible. I know you can't avoid everything, but try to avoid accidents. Keep your workspace clean. If you see any potential hazard, do your best to eliminate them. The Next thing is to pay attention to your headcount. So you might have had every intention of being as accurate as possible when reporting the payroll, but it's a prediction, right? You never know what happens in business. Business goes up, business goes down. Sometimes businesses are growing, you're increasing your headcount. Obviously, you're paying more in wages. So that headcount goes up, your wages go up, you get that surprise bill, at the end of the year. So just be cognizant of your headcount. Try to get an idea from your insurance person what your workman's comp insurance rate is. And then be cognizant that if your wages are going up or tend to be skewing and you're growing, that you are putting some money aside or anticipating having to pay this bill. If your business is declining and your headcount is declining, that works in your favor because on a workman's comp insurance side, if your wages are actually below what you anticipated paying out, you are actually entitled to a refund of some of the. So it does work both ways. You want to monitor closely your headcount and total wages. The last thing you can do, and this may or may not be an option for everyone, there are payment plans for workers' comp called PAYGO, which is short for pay as you go. It allows you to pay your premiums as you go. So you would pay your workers' comp premiums on a weekly, bi-weekly basis, whatever the frequency is that you run your payroll, you can pay the premiums along with that. This works well because it doesn't require a lot of money up front, and it gives you an accurate and real-time calculation of what your payroll actually is, because you are calculating the premium payments that you make based upon the payroll that you've had. So if you have $3,000 in the last set of payroll, you'll pay the premium on the $3,000 then and there. The next week you have 5,000, you pay the premiums on the 5,000 then and there. It allows to be very accurate with your estimate. You're still going to get audited, but usually if there is a difference, it's not that much of a difference because you've been paying over the course of the year based upon actual payrolls. So talk to your insurance person to see if that's an option, because that's a great way to avoid surprises. Not all plans offer that. It works well if you have fluctuations in your employees. For example, I operated a caregiving company for the elderly where the caregivers were paid by the hour, but those payrolls fluctuated. They were never the same because folks' hours are different. Sometimes folks didn't show up to work, or sometimes the client didn't need them. We were dealing with the elderly, so things happen. The elderly get sick, they get hospitalized, they unfortunately pass. With that, we had a good amount of fluctuation in the payroll. The pay-as-you-go program served me pretty well because it allows us to stay accurate with our premiums, and we avoided any large bills at the end of the year. So those are the things that you take a look at. So that's all for now. I hope this helped. If you have any more questions about this topic or any other accounting or tax related questions, feel free to reach out. I'm happy to help. All right. That's all for now, and I'll see you on the next one.